Welcome to part 2 of our presentation. And before we started, I thought it would be useful to just do a quick recap on some of the key learnings that we have outlined in part 1. We have discussed in part 1 what a CCP actually does, what its function is. We have considered in quite some detail and contrasted two quite different default events and outcomes with Lehman Brothers and Nasdaq clearing. And we have started to consider some of the EU regulatory developments and the genesis of what we call AAR. And at the heart of these developments are the EU concerns about CCPs in London, whether they are reasonable. What are the real risks in clearing euro derivatives outside the EU, or of clearing cash market trades at multiple CCPs instead of a single EU-wide clearinghouse? And consider again the case of LCH. As we've outlined, it was a successful clearing, and the default resolution at the swap clear service, a timely auction of the portfolio to other members, no recourse to the CCP default fund, and no CCP-driven disruptions to the business as usual activities in the OTC RS market, despite significant and observed market volatility during the time. And well, I remember that at the time as a chief risk officer in London. This historical evidence, in other words, regarding an LCH, a swap clear default event, is that it can be properly managed even in times of severe market stress. And we will come to that a bit later on in our discussion. The very move, therefore, we would suggest to onshore some of those activities from London to the EU will, in our view, potentially fragment liquidity in the OTC IRS market. And such fragmentation in and of itself will be a driver of systemic risk in times of market stress. Ultimately, and we will develop that a bit further, active account requirements will not advance financial stability in the EU, as we're trying to do within the CMU initiative or indeed in the Draghi report, but will negatively impact EU market participation. Thirdly, the additional liquidity available from LCH from auctioning a more balanced, though much larger and more complex IRS portfolio to a wider set of clearing members generated a better outcome for the CCP and for the wider market as a whole than did the outcomes of the Nasdaq clearing arrangement that Nick highlighted. Finally, the proposed clearing fragmentation under AAR, clearing only a proportion of euro-denominated positions separately from those OTC IRS positions remaining at LCS or other non-EU CCPs, and only by clearing members subject to EU clearing mandate, can be argued, and we would suggest that, actually increasing systemic risk rather than decreasing it. CCPs globally, and does geographic location matter? How varied are, in practice, the regulatory regimes, and does geographic location and relocation, as proposed, at least for part of the activities under AAR, to the EU, matter in terms of oversight? Well, first of all, there's been a very significant international harmonization in the CCP regulatory space. Since the introduction of the principles of financial market infrastructure, the PFMIs, as already mentioned by Nick earlier on in the part 1 of our presentation. Secondly, in terms of current CCP structures globally, the development of clearing services for OTC IRS in other markets, for example Australia, with similar exposures to LCH exist. In other words, there are already market activities taking place which are very happily cleared and settled through LCH from other geographic regions. A similar regime of regulatory equivalency has been implemented to that existing for the moment, at any rate, between the EUI and the UK under the so-called equivalence arrangements. The acceptance of regulatory equivalence between different jurisdictions and CCP recognition is increasingly viewed as being best practice by jurisdictions that have accepted the PMFI framework, and continues to indeed be, ironically enough, widely used by the EU itself. On to the next slide, and over to you, Nick.
Yeah, thanks again, Jean-Jacques. So I've just brought up some of the details around the AAR, and I wanted just to highlight something that Jean-Jacques mentioned earlier, that it covers, first of all, both financial and non-financial counterparties. And that's important because if you think about the LCH swap clear service, and you think about the primary OTC interest rate swap clearing service available inside the EU, which is via Eurex, with regard to the bank clearing members, the financial clearing members, the globals that would be subject to EU supervision as a part A of the AAR requirement that I've listed here, they would largely already be clearing at both LCH and at Eurex. So they would already have facilities set up at Eurex that would basically meet the AAR. And they do that for their clients. That's the reason they even though they clear in aggregate in excess of 90% of the market via SwapClear at LCH, their clients, their EU clients, particularly their larger EU clients, really value the ability to clear locally inside the EU when it suits them, and that would include EUR-denominated interest rate swaps that are covered by Part B of the AAR. So the clearing members that are involved in this AAR are going to be caught and made eligible under AAR. They're probably already meeting the requirements. You know, there may be some additional operational or reporting requirements that they have to meet, but by and large, they're already there. And so when we look at the market feedback, for example, on AAR for the swap market, really the comment we're seeing is it's the clients that are going to be caught up. They're going to be the ones who have to make the new arrangements in this, even though they may have no interest, you know, in maintaining clearing arrangements at two CCPs, at LCH and at Eurex. If their preference is to clear at LCH, they're going to be forced to maintain accounts at Eurex as well. And so the comment is really, you know, this is actually going to be a net cost on the client side for EU pension funds, for example, that they didn't face before. And you know, when it comes to the costs, we haven't seen a lot of meat on the bones from the EU in terms of where they expect the costs to lie. But I think that's an important piece of information that the market's looking for in this story. The liquidity fragmentation topic that Jean-Jacques touched on, I think that's pretty central to the comparison between the two default events that we looked at earlier. You know, the difference between the two default events is really the size of the open position. And if you've got a portfolio of interest rate swaps that you're currently clearing at LCH, and you're told that you need to clear the EUR-denominated portion of those at Eurex, that's going to split the portfolio, and it's going to create open positions where one probably didn't exist before. And that's the same type of open position that we saw leading to problems in default management closeout with the NASDAQ AB clearing service default event. So we see a direct link between AAR and liquidity fragmentation through the split, if you like, between the portfolios at LCH and what's being proposed to be cleared inside the EU.
Okay, thank you very much, Nick. That's absolutely right. So just let's get to the nub of the issue. Why does the EU require this onshoring, the AAR initiative, splitting the portfolio, if you like, and increasing the cost for at least some of the euro-denominated IRS, as Nick and I have pointed out? Well, first of all, there is the assumption by ESMA and indeed the EU that these proposed measures of splitting the portfolios, if you like, will have a positive influence, a positive impact on the attractiveness of EU CCP like Eurex, enhances financial stability, reduces excessive reliance on third country CCPs like LCH based in London, and ensure a safer, more robust, competitive post-trade arrangements. Now, these are very large assumptions. EU also is of the view that onshore clearing, central clearing, will further strengthen the still struggling CMU initiative and contribute to deeper and more liquid capital markets. A large assumption, as we've just pointed out. We believe that the opposite will happen, that actually liquidity could be negatively impacted. Thirdly, by geographically locating clearing within the EU, onshore CCPs will theoretically benefit from increased volumes. Again, an assumption, therefore, be able to bring more quickly new products to market and meet the demands of clearing members and for new services. Fourthly, it is felt that CCPs should be able to adapt the models they use much more quickly to measure the risks that they face, allowing for timelier management of risk. And finally, clearing members, mainly the banks, should potentially benefit from expanded clearing choice between offshore and onshore, and able to thereby also give more choice to clients. Now, as Nick quite rightly pointed out, it is in fact going to probably be more costly for the clients of CCPs rather than give them a greater choice. Choice does not come without cost, quite clearly. And that's the key issue that we need to consider in summing up. So let's move to the final slide, if we may, which we've outlined for you. Some of our critique of the AAR and the functioning of CCPs in the UK and the EU resonates actually with published market feedback, particularly on the costs facing clearing member clients, quite rightly, like pension funds, for example, subject to EU oversight, which market participants fully predict will give rise to greater costs, as they are forced to maintain active accounts within the EU on top of those existing clearing arrangements. Nick.
I would add to that. We heard earlier that the two systemically important clearing services that are caught under this AAR in the UK include also, apart from LCH, the ICE Clear Europe service, which is primarily credit default swaps. Subsequent to the publishing of the AAR, ICE Clear actually moved that business out of the UK, and though that they no longer clear CDS at ICE Clear Europe. So the very portfolios that led to ICE Clear Europe attaining systemically important status by the EU no longer are cleared at the service. And the EU, in its most recent publications regarding AAR, has noted this and said that those portfolios would no longer be subject to AAR. So even though the portfolios are being cleared somewhere else, some of the porting might have been done, for example, to ICE in the US, might have been done to other credit derivatives clearing services, but those portfolios still exist, and yet the systemically important designation no longer attaches to the clearing services where those portfolios are cleared. So to us, it begs the question of how the EU views the definition of and the assignment of systemically important CCPs in the face of the ability of CCPs and clients and clearing members to port their portfolios across to other CCPs. It's a bit unclear to us how simply dropping the systemically important designation makes sense when we know that the portfolios are still being cleared somewhere.
Yeah, I think that's right, and what is quite clear by simply moving CDS clearing entirely outside of the EU market, far from achieving the objective to expanding CCP activity within Europe, the opposite has happened, and I think that just goes to show that in support of the stated goal of developing further the capital markets union, creating greater efficiencies on a single intra-EU market for the efficient flow of capital is actually not going to happen with, in our view, the imposition of AAR. And it seems to us, as a concluding observation, that instead of political decisioning on where CCP clearing should take place on a geographic basis and oversight imposed upon the CCPs, the clearing members, as we've seen very much in the case of LCH, the clearing members, the agents and the clients are best positioned themselves to ensure and coordinate systemically effective solutions in liaison with the regulators, which is the way we would encourage it to take forward. And we've seen that amply evidenced in the Lehman's case. Now this brings us to the end of our presentation, our two-part presentation. We will follow this presentation up with a publication, a working paper here at the EUI in the course of the summer, where we will develop these themes in a lot more detail, with more examples and more analysis that's coming out, because it's a living problem. EMIR and the EU Commission are very concerned with maintaining and growing and further developing the capital markets union. And as we have explained in our discussion to date in this presentation, that is not quite working in the direction that they would like to do. So thank you very much, also on behalf of Nick, for your attention, and I hope that you've enjoyed our presentation. Thank you very much indeed, and goodbye.